Good morning, everyone. Jason's my name from Property Investors. It's been a minute since our last webinar, but that's okay. We've got obviously a very, very topical subject for this webinar and the next one. What we'll do is we'll have one today and we'll talk pre-budget, and we'll obviously talk post-budget, because whilst there's a lot of speculation about what's coming out in the budget, which is unsurprising, we don't want to be talking about strategies for things that may or may not actually come out in the budget itself. So that's why we should actually look at it afterwards. So for those of you that don't know much about us, and this is your first webinar, you're looking at potentially being an affiliate with us, welcome. Just give you a little quick background. So I've been investing since 1996. I was mentored very, very well. At the time I met my mentor, he was 36 years old. He had 44 properties, and he very much showed me a matrix formula for finding properties to maximize capital growth, maximize cash flow, and minimize risk. So I was very, very fortunate to spend a lot of time with him. He's now a venture capitalist billionaire in the US. And then as it turned out, I was mentored again years later when I actually was doing the seminar circuit with Tony Robbins and Jordan Belfort and whatnot. So I've been really, really blessed. I've had a lot of good guidance. I've been given an enormous amount of insight, and over the years I've obviously met loads and loads of people in this industry and seen some people get some incredible results, and including my own clients. We've had Property Investors going now since 2012. We've got 2,600 investors that have now just shy of 6,000 property investments. So we're not small. We're certainly not the biggest, but we're definitely not small. And the reason why I told you those stats is that we've obviously got a very, very high reinvestment rate. So people obviously have a good experience, they're making money, they come back and they do it again and again. So the biggest source of our new clientele comes from people that are coming back and actually, they're investing again, their referrals, and also professional affiliate referrals. So I'll talk a little bit more about our process at the end, but let's talk more about sort of the topical federal budget that's about to come out. So here's the dilemma, and this has created an opportunity for us, and I'm going to talk about that as well today. So number one, the government have some issues. They've got no money. Right, so that's the first problem, and usually a Labor government will want to solve that problem with tax. So any kind of tax reform, introducing new tax, etc. And that's why there's been a lot of talk about reform around negative gearing and CGT. So they've got no money. Also, since COVID, they've printed just shy of $300 billion. So if they're trying to convince us that it's our fault that we've got high inflation, that's obviously ridiculous. They've printed an enormous amount of money, and it's no surprise that we've obviously got very, very high inflation. The other issue is that there's just shy of now $1 trillion worth of debt. So this is very much a political budget, in the sense that Chalmers doesn't want to be pinpointed as being the $1 trillion deficit guy, even though that it's really all Labor's doing. But anyway, that's a whole nother conversation for another time. The point is that they want to keep it below that $1 trillion mark. So this is very much politically motivated in a lot of sense. The other thing that we've got a couple of compounding issues with respect to property. The cost of construction is not going down. In fact, it's under the most amount of pressure that it's probably been in since we had, obviously the post-COVID era. And the first one is that since the 1st of April, so the 1st of last month, there's 249 categories of products that export from China to us, and a lot of those are actually used in construction, and they don't have the VAT, the China VAT rebate anymore. So that 9% rebate has to be budgeted into the Chinese wholesalers, and that's obviously having upwards pressure on construction price. There's also the fuel crisis that undoubtedly will have upwards pressure on construction price as well. So construction costs have an enormous amount of pressure. And the other issue, of course, is that from a Australian property point of view, there's a very precarious situation where the overall loan to value ratio across the board is just a smidge over 60%. So a 60% LVR on residential property in Australia. So the banks obviously have a very, very big they've not only got a lot of influence in terms of what the government will or won't do, but they've actually got a lot on the line, and that's why the government are going to be very, very careful about policy and how they implement it. So that's what's obviously raised all of these issues around CGT. And will CGT reform? Will they remove the discount? Will they go back to an indexed calculation method, which they had before 1999? And will they look at either scrubbing negative gearing, or will they actually reform negative gearing and have it maybe just for new homes? So obviously that's what's on the chopping block with respect to the actual federal budget that's actually coming out. So in order to keep this $1 trillion worth of debt below, clicking over, there's no slowdown, it seems, of migration. So that's obviously going to maintain very, very high. The other thing is that the 5% deposit scheme that the government has been giving, there's just over 16% that have gone to new migrants, right? So there's an enormous amount of migration policy, and it's arguable that there's fishing for votes, etc. There's also there's this upward pressure on interest rates because of obviously the inflation scenario. So there's all sorts of issues that this government has, and it's very much a political budget for a whole lot of points. Now, let's do a zoom out, because we need to really understand what the implications are on all of these things, and we need to understand the implications of negative gearing in particular, because from a CGT point of view, there are absolutely different ways in which there are strategies for corporate structuring and different types of structuring to actually minimise that. But that still depends on whether your exit strategy is to sell investment property or whether it's to retain it. And there's all various different strategies in which that can obviously be attained. Just before I talk about sort of doing a zoom out on property, this is something that as an organisation we love, this type of transition where there is an enormous amount of talk in the marketplace, there's a lot of fear, and it really sorts out professionals from amateurs. So the same is happening in the real estate space. Probably you guys are feeling it. If a lot of you are brokers, you're feeling the same thing, and certainly we are as when we're actually specifically in the property investment space. And I'll give you an example. After the GFC, when the government introduced fiscal and monetary policy and started dragging down interest rates and started giving lots of incentive to first-home buyers to stimulate the construction field, and also to keep the market moving along, and obviously first-home buyers, that then created this perfect storm where we had a market that was increasing and we had super low cost of money. We had 2%, some interest rates had a 1 in front. So the frustrating thing for us and for someone like me in this space is that all of a sudden every single person's a property expert. And it's very, very frustrating because, of course, everyone's a property expert if the market's booming, the cost of interest rates are really low. And I was looking at a lot of what people were actually investing in, and like, it's great now, but wait until interest rates go up and you'll realize what you've just done. So there was no real forward planning for everything that always happens within cycles. And so this is now very much a pointy end of really sorting out the professionals from the amateurs. And as an organisation, we are very much ready to pivot on this. So like I said, let's do a zoom out. Now, negative gearing, this is something that a lot of people don't really truly understand the history of. Negative gearing was first introduced early last century. And the reason for the introduction, well, before I talk about the reason for the introduction of negative gearing, let's talk about the number of taxpayers per retiree. So in the early 1900s, so sort of 1920s, 1930s, there were 12.1 taxpayers for every retiree. So there was a lot of tax revenue for any retiree and so on. So there was no real fear about whether I'd get looked after by the government in terms of retirement. I work in my job for 20, 30 years, so I get my fake gold watch and then go into retirement, and there'd be obviously support from the government in doing so. So that was very much the whole psychology back then. And if you think back to conversations with your grandparents and those generations, they were very much about job security for a long period of time, and there was really no fear about sort of doing any forward planning for retirement and having enough assets in retirement. So as time progressed and we got to the 70s, that then dropped back to seven out of every, so there were seven taxpayers for every retiree. So it reduced quite a lot. And then by the time we get to 1996, it was down to less than five, and now we're almost at parity or below. So there is not a lot of tax revenue to support retirees, and that's why there's been an enormous amount of focus for people to actually put a lot of their energy and planning into what I'm going to do in retirement, and is the government still going to be there for me to actually carry me? And they're even wanting to dip into my superannuation. So the psychology in the early 1900s wasn't about retirement. So why would the government introduce negative gearing? Well, they introduced it to give incentive for obviously people to invest in properties to create more supply of rentals. That was the whole purpose. And the government worked out that it was a lot cheaper for them to give a tax incentive to a private investor than it was for them to build government housing to provide a supply of government housing to then keep the rental price down. And so that happened for a lot of the 20th century until 1985. And so in 1985, the Hawke government with the Treasurer Paul Keating basically had a rhetoric to the Australian public that negative gearing was actually costing the government too much money and it supported the wealthy. Now, even though that's absolute bullshit, and it is, because negative, in my experience, and especially with the strategies that I've sat down with people that actually have high net worth and high incomes, we're not doing a negative gearing strategy. We're usually doing positive gearing strategies, and we're manipulating ownership between spousal income, et cetera, so that we can actually build a portfolio that's very, very diversified. So they've got blue chip shares, they've got some precious metals, these days they've got crypto as well, and they've just got a lot more money. And those sorts of strategies for those individuals that are much more high net worth, that would be probably the top 5% of our clients. 5% of clients would be high net worth with very, very different strategies in that respect. But with respect to negative gearing, that's to support middle income earners that really need those tax credits to have the cash flow. So to say that negative gearing is supporting wealthy people is great rhetoric, but it's actually not supported by fact. And so in 1985, the Hawke government axed negative gearing. It was literally gone. And here's what happened, right? And I'll just share my screen because I pulled up an article from July 4th, 1987. And it was in 1987 that the federal government, the Hawke government, had to reintroduce negative gearing again, because guess what happened? All the rent spiked. And it spiked considerably, and it became a disaster. So the supply of those rentals dried up. Now, look at the perfect storm that we have. We still have very, very high migration. We've got this fluctuation in interest rates. And when interest rates go up, if you look at historical data, more people tend to want to rent than buy because it's obviously more affordable to do so. There was a hangover from COVID where there was actually a lack of supply of properties. And if you remember that this current government was talking about constructing and building a supply of homes for Australians because of obviously the affordability crisis. And by the way, in my entire career for the last 30 years, all I've read in the media is about Australia bubble that's going to burst and the affordability crisis. That's all I've read. It's been the one thing that's been consistent in every single market that I've ever been through. So the reality is that if the government decide to axe negative gearing, that's going to have a gigantic impact on the rental market, and it'll have a big impact on the property market. And keep in mind that just over 60% LVR across the board in residential property. So the banks are going to actually scream blue murder if that happens. Now, I don't know whether it will get that far, but if it does, then we're going to have a real problem, because if we have median house price move too much, then, like I said, the banks are going to have a real problem, and that's going to have a knock-on effect to obviously the government itself. So that's why I doubt whether it will actually get that far. I think it'll be more reform associated with, maybe negative gearing only for two properties or for the new properties, or all these different things that they're playing around with and that's on the table that we won't really know until next week. But either way, there is then a shift in strategy. So whatever the government does, we then just shift in terms of the strategic approach. And notice how self-managed super funds haven't really been looked at much. And the CGT, so if they impact the CGT on asset growth, it's not just property asset growth. And we don't believe that they're trying to look for revenue in the short term from property. They're trying to look for it from other assets, all right? And whether that be crypto or whatever the case may be. But either way, it gives us an enormous amount of opportunity to pivot. And that's why, from our perspective, we're very, very excited about the movement that this creates. When it's going the other way and interest rates are super low and the market's really getting carried away, it's very, very difficult to get people to listen. But all of a sudden, everyone's listening to us now. In fact, just with an affiliate attendance today, this is the biggest attendance we've had, right? Because it's very much this topic of conversation. And so the same thing we're finding with our clients. Now, if you're a broker and you've got people that are starting to, they want to put their properties on the market and they want to start actually advertising their properties because they're paranoid about whether they're going to be able to claim their negative gearing component, etc., or they're not, intending on settling on a property that they're wanting to purchase, or they're not following through with the purchase, well, then the last thing we want as a broker is to obviously have clawbacks, etc. And that's why very much we are all about that creates new opportunity. So I'll give you another example that happened when COVID hit, because when COVID hit, there was, again, a lot of uncertainty in the marketplace. A lot of people had a lot of fear. And I know for myself, just in terms of my pipeline with my own clients, I mean, I lost probably about 12 different clients in pipeline in about a week. It was very, very impactful. And I must admit, during that week, I had my head in my hands going, oh my God, what's going to happen? Because none of us had been through that whole psychology of a pandemic before. But we held our ground and we still followed through with, obviously, the formula that's always worked for us that my mentor had taught me 30 odd years ago. And so just for those of you that don't know what that formula is, we've always stood by that the area that we go to has a minimum yield of 4%. So the annual rent as a percentage of the value of the property is at least 4%. The area is going through heavy gentrification. So that means that any oldies in the area are dying or moving off. And then there's a population net gain of young working people. So in the case of houses, they'll be young families, maybe couples. In the case of townhouses, it's quite often couples, maybe some new families. And then if it's boutique apartments meeting the same criteria, it could be young professionals, singles and couples. Either way, with all three of those asset classes, all of our clients have always won. So our 6,000 properties of what our clients have invested in, they're all cash flow positive, they're all growing. All right, and that's because we've just maintained and followed that formula. So COVID hits and we go, oh my God, what are we going to do? So we then looked at, they've shut the international borders. There's not a lot of gentrification, which is what we need in a lot of the traditional areas that we were sourcing back in those days, except for Southeast Queensland, because a lot of people were moving from Sydney and Melbourne in their droves, if you remember. So very, very early in that whole cycle, no one knew what was going to happen to Southeast Queensland back then, but we were looking at it, we're like, well, that's really the only area in Australia for us to actually source property. And so we were sourcing 2-bed, 2-bath, single car space apartments in Maroochydore, $430-ish thousand, brand new, with a 18-month to 2-year settlements. Then we had townhouses in areas like Pimpama, in that sort of growth corridor in between Gold Coast and Brisbane. So they were low 400s. So those apartments, by the time they settled, the valuations came in at 700,000 plus. They now obviously have one in front in terms of millions. Those townhouses, they're at least going for just sub $1 million now. And then we're getting 4-bed, 2-bath, single double lock-up garages in Redland Bay in a land lease estate, packaged up at 580,000, and they're now obviously worth well over $1 million as well. So all of our clients doubled their money, and a lot of people said to us, how did you predict that? Well, we didn't predict it. We just kept following the formula. So no matter what the economic chaos or climate was, we've always just stuck to our guns because the formula is about the movement of supply and demand. And the yield tells us whether it's overpriced or not. And so that's why it's very rare that we'll source properties in Sydney, because the Sydney yields are very low. And so the moment the interest rates go up in Sydney, that's where you'll tend to find there's big fluctuations in some of the suburbs of the median prices in those suburbs. So post-COVID, we then saw a very, very similar pattern of numbers happening in Perth, and then the same thing happened in Perth. We were getting actually 4 to 5 bed houses, double lock-up garages in the northern growth corridor, southern growth corridors of Perth. They were mid 500s, so we're getting sort of packaged of about 560. They're now all sort of pushing sort of the late 800s and early 900s in terms of value. And so that's where obviously we moved for the next few years. So the point is that we don't freeze when these sorts of things happen from a government. It creates opportunity for us, because all of a sudden we've got a captive audience, because we've got a very, very good record. We are very resolute in terms of this, the strategies that we follow, and obviously the clients will listen. And because of our track record, and because obviously we have so many clients and they're referring people, and I mean, I had a conversation with a client this morning, and they had a number of questions about a property that they had. And he said, Jason, thanks very much for re-explaining that to me. He goes, I knew that you had a plan for us. He said, I just couldn't remember what it was. And so that's the constant feedback that we actually get all the time. And so just to give you some perspective on a zoom out, all right. So right now we've got the government doing what it's doing, whether it works with negative gearing, CGT, whatever it does, we all know it's very much some political moves. We now understand that the banks have a very, very big say, because there's an over 60% LVR situation with them, and they obviously don't want big fluctuations in the market, because then we've got an absolute disaster if we've got banks, obviously caving. The other factor that we need to keep in mind is the top 5 land developers that pretty much control the entire market. So Stockland, Mirvac, Lendlease, Peet. So Peet have been around since the 1800s. So think about that for a moment. Peet, they're the oldest developer in Australia. They're the 3rd oldest company in Australia. They've been through the Great Depression, 2 world wars, Black Monday, GFC, pandemic. They've been through all of it. So these guys, all collectively, just the top 5 developers, they're controlling 200,000 house blocks at the moment, or thereabouts. Some would say it's more than that, but let's just call it 200,000 blocks. So they actually control the market, and they control the market by the way in which they release their supply. And there is no way that they'll actually release supply and discount the actual price, because that then discounts the way in which they value those blocks on their balance sheet. And if they did that, they'll get a contraction in their value. They'll have screaming shareholders and screaming banks that are actually leveraging them. So they never do it. They just traditionally will never do that. And to give you an example, when the interest rates were very, very low, just in Melbourne alone, the number of blocks being sold per month was about 9,000 to 10,000 blocks per month. When they started increasing interest rates a few years ago, post-COVID, the interest rates went up. The prices still increased when they did a land release or a stage release on a particular estate. So they still increased the price in the same rate they were still doing when they were selling 9,000 to 10,000 blocks a month, but they're only selling 1,000 to 1,500 blocks. So they don't discount. What they do is they slow down the release of supply to maintain the value, because the last block sold is basically what dictates the value of all of their 20,000 blocks in that area, in that region. So they're never going to discount. So there are very much commercial forces that, whether they agree with what the government are doing or not, we all pivot. And that's why we watch everyone very, very closely, and there is enormous opportunity that arises. And that's why even just the opportunity that came from COVID, we then went on to have record year after year after year after year after COVID. And when interest rates started increasing, it just compounded and got even better for us, because all of a sudden, all of our expertise became very, very obvious. But when the interest rates are really low and the market's really booming, it just gets washed out with everyone being an expert at those phases. And so that's why we're very much looking forward to that. Now, for those of you that aren't familiar with our process, so when we meet with a client, quite often a client doesn't realize what they can or can't do. And because the properties that we source are very cash flow focused, as well as actually capital growth focused, one of the things that we'll do is we'll sit down, we'll go through a fact-finding session, and then we'll build a strategy based on their current situation and then having a forward plan. And in that forward plan, in my experience, most people don't account for what is the exit strategy. And the exit strategy is really important. So even with high net worths, I mean, I've had people, my biggest client has a $50 million portfolio. When I first met him, he had a $20 million portfolio and he didn't have an exit strategy. He was just accumulating assets. He had somewhat of a strategy as to how he assessed those assets. So he wasn't stupid, but all of them were based on opportunities. An opportunity came up, something hit the market. It was literally, that's what he was doing. And that's what my experience is with not only high net worth investors, but also brand new investors. They do it based on what opportunities are available to them, instead of actually mapping out, well, how am I going to live on these assets when I retire? And let's work on a way backwards from there. And that's why a lot of our clients have decided to add superannuation properties into that matrix, because it actually is part of their no CGT exit strategy at the end, where they can eliminate debt on their other properties with the potential sale of that property if they wish to do so. So it gives them options at the end. So there are so many different ways to skin the cat. And so when we go through those steps with the client, what's important to us is them understanding what the strategy is, them understanding how we source properties, us then building up it's almost like a due diligence kit, but it's actually research on the area and why that has upward pressure on cash flow and capital growth based on our three criteria of minimum yield of 4%, heavy gentrification, and the property being brand new. So as a result of all of that, the client becomes very educated. And when we have a situation where interest rates go up, or the government's looking at changing policy or whatever the case may be, we don't get 2,600 clients freaking out, calling us saying, oh my God, what are we going to do? Or if they lose their job or any of those things, because they're well educated and we've got stopgap strategies for all of those different circumstances. But it's all based on the premise that we invested in the right property to start with. So there's plenty of cash flow to work with, and there's plenty of capital growth to work with. And so if we need to pivot, we can pivot, and there's plenty of things that we can actually do from there. So there's not really a lot more that I can say today, because we really need to have a look at what actually gets over the line next week with, obviously the tax reform around this. But I am very excited about it. I'm not necessarily excited about the people that will lose from it, but from an organisation's point of view, every time the government do something like this, we then are beyond busy, right, in terms of actually being able to keep up with things, because it's very easy to pivot strategies when the government say, right, we're making this change. And just have a think about it for a moment. Imagine if the government acts negative gearing, and and it was grandfathered in a way where everyone with a negative gear property doesn't get those tax benefits anymore. I mean, could you imagine what would happen to the property market? Could you imagine what would happen to median house price, right? The impact that would have. Could you imagine what would happen to rents? So whilst a lot of people like to say that our Prime Minister is dumb and stupid and all those things, there's got to be commercial forces that will actually force their hand. And will that end up getting up or not? They're the things that we need to obviously assess and wait and find out. But either way, there's going to be plenty of opportunities in terms of investment opportunities, different types of strategies, and lots of ways for us to obviously pivot. And that's why we are very, very geared up for pivoting when that happens. And the feeling that we're getting already is that there's going to be a lot of activity just from our own client base. And I'm sure you guys are as well. And if most of you, which I think you are brokers, there's going to be an opportunity for you guys to go back to your whole client base, to revisit the strategy and obviously do a loan health check on their current situation, how that can obviously be maximized. There's going to be loads of different ways that we could all work together in order to obviously facilitate all different types of strategies for our clients. And just to remind some of our existing affiliates, and if there's some new ones with us today as well, there's some new ones that'll see this recording. We don't expect you to put all of your clients' faith in us from, on one instance, on having a couple of meetings with one of our representatives. We don't expect that, and that's not something that builds a long-term relationship. We've built long-term relationships not only with our clients but all of our affiliates. And the thing that I've always said to any new affiliate is just refer one client, sit shotgun on all of the meetings, and let me show you how that we look after the client, how we educate them, the strategies that we implement. And then let's have a debrief at the end. And then let's go, right, well, how do we access some more of these clients? And what's the best client that you could potentially refer to us? Or how could we potentially reach out to them and go through that process? My guess is that I'll be running a lot more of these webinars, not only for you guys, but a lot of affiliate client base. I'll certainly probably be doing it for our own clients. But my guess is we're going to be doing a lot more of this once we actually know where we stand with obviously these, the new government policies with tax reform around, anything to do with obviously property. And there's a potential that we, are really going to be able to help a lot of people and going to be able to capitalize and maximize on it. All right. So I've gone over a little bit today. I usually like to do these webinars in 20 minutes because I know people are very time poor. But I can see that the attendance today is a lot higher. Obviously, we've all got a vested interest in this. So let's wait for the budget. Let's see what happens. And so Tim and I and our team, we're going to obviously work very quickly on pivoting and making sure that we've got the appropriate strategies in place. And we're going to be operating on that immediately. And so what we'll do is in our next affiliate webinar, we're going to talk very much about those strategies that we're implementing for our own clients and the impact that we're actually seeing in the marketplace. All right, guys. Well, look, thanks very much for attending today. Have a great morning, and we'll see you all after the budget. All right, cheerio.